Welcome to our Hurst Cycles webinar for the 12th of February 2018. My name is David Hickson, and before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. Today's webinar is really a continuation of the discussion that we've been having over the past few months. So if you have missed our previous webinars, I would encourage you to go back and take a look at those webinars. They are available on YouTube. And in our previous webinar in January, of course, I was discussing the reasons why I was expecting a peak. And here is a chart of the S&P 500. I was expecting a peak in the US stock markets, not only the US stock markets, but stock markets around the world, because, of course, stock markets around the world move with a great deal in common. But the example that we've been tracking and the analyses that we're looking at are for the S&P 500. And here is the S&P 500 now. Our previous webinar on the 15th of January was, I believe, over here. There we go. So that was the 15th of January. The markets moved up very strongly for the next 2 weeks. And of course, you can see what happened after that. Indeed, a peak did form in the markets, and they've been coming down very hard since then. So that was no surprise for a Hurst Cycles analyst or for anybody who's been following these webinars, because it is exactly what we expected. So the question now is, what happens next? Okay, as a cycle analyst and somebody who trades the markets on the basis of Hurst Cycles, we're always looking ahead, and we're always asking, what is the next thing that's going to happen? So, first of all, how long is this market going to be going down for? Because it's been falling fairly steeply. And so the question that's at the top of everybody's mind is how long is it going to keep falling for? And, where are we going from here? What's the next big event that we are going to witness? Well, let's start putting some analyses up onto this chart. I've hidden the peak analysis just to show the price action, because the peak analysis that Sentient Trader has performed, and I haven't messed with this analysis, this is just the default analysis that Sentient Trader is performing. I am using a slightly unusual nominal model as discussed in previous webinars. I won't go into that at the moment, but this nominal model includes a 6-year cycle, which normal Hurst nominal models don't. I think a 6-year cycle definitely seems to be evident in stock markets, which is why I've included it. But let's not get distracted into a discussion about that at the moment. So the first question to ask when we're going to consider what's going to happen next is, what is the magnitude of that peak that formed at the end of January? So here you can see a really big pile of triangles marking that peak. And you can see that according to this analysis, that peak has been marked as a peak of the 9-year cycle. Okay, so that's a really big peak, a very prominent peak, very important peak. And certainly, the last 2 weeks of price action seem to indicate, yes, we are falling from a really big peak. I must tell you, though, that I am always very wary to either call a very big trough or particularly call a very big peak. And you will know from our previous webinars that, in fact, I was expecting a peak of at least 18-month magnitude, an 18-month cycle peak. So I'm not going to go through the reasons for that again, because I discussed them previously in the webinar, and let's not waste time by repeating ourselves. As you can see, the software, Sentient Trader, has made that a 9-year peak. So how do I deal with that? Well, I treat Sentient Trader with respect. I love Sentient Trader, obviously. I created it. And when Sentient Trader says that's a 9-year peak, I say, yes, maybe that is a 9-year peak, but I have my reasons for thinking that, in fact, the 9-year peak might have occurred in 2015, as discussed in a previous webinar. I say might have, because this might be the 9-year peak that we're looking at. But the 9-year peak might have occurred in 2015, in which case this peak was a peak of the 18-year cycle. Now, I know that some people find it very disconcerting when I do this, but let me explain why and demonstrate to you how I work with this slight vagueness, if you like, in terms of the magnitude of both troughs and peaks, because I do it for both troughs and peaks. When I see a really big peak like that, yes, it is possible that it is a peak of the 9-year cycle. But what I like to do is I like to work out what I call my level of confidence. What is my level of confidence in that peak? And my level of confidence is at the 18-month level. In other words, I am confident that that is a peak of at least 18 months. Okay? 18 months is a pretty big peak. And so, that's big enough for me to make some sensible trading decisions. It is possible that that is indeed also the peak of the 54-month cycle, maybe even the 6-year cycle, if the 6-year cycle exists, and indeed maybe also the 9-year cycle peak. But I can make trading decisions on the basis of the fact that it is an 18-month cycle, and keep in the back of my mind that it might also be a 9-year cycle peak. But I don't have to make a decision about that. So I hope that's clear, is that yes, it might be a 9-year cycle peak, but I'm not going to label it as such just yet. I could fiddle around in the software and I could start pinning peaks and moving things around so that I'm seeing only an 18-month cycle peak over there, which is my level of confidence. But most of the time I don't bother with that, because it's not really necessary, particularly in terms of the discussion that we're going to have in today's webinar, which is about what's going to happen next. So my level of confidence in this peak is at the level of 18 months. So I believe that was a peak of at least 18-month magnitude. It might have been a bigger peak, but I'm confident that it was an 18-month cycle peak. I must just repeat a little bit of the discussion from our previous webinar, which has to do with the fact that peaks are complicated. And you must understand that we're looking at an analysis here which is assuming that peaks are synchronized. Now, peaks often are synchronized, and of course if that is a 9-year cycle peak, then every peak from 9 years and shorter, every cycle from 9 years and shorter probably formed a peak at that point. So we might indeed be looking at a synchronized peak, but we cannot assume that the peaks are synchronized for the purposes of the analysis, which is why I always take the peak analysis with a little bit of a pinch of skepticism. And I don't just look at the software and say, wow, that's a 9-year peak 2 weeks after it has formed. It might be, might not be. But I'm confident that it is an 18-month cycle peak. Okay, so what is going to happen now? Well, if that was an 18-month cycle peak, as I believe it was, then what the market is going to do is it's going to move down into an 18-month cycle trough. Now, that might sound like a really sort of obvious and almost a stupid thing to say, but it's worth thinking through this fairly clearly. And so I'm going to zoom in here and discuss the way in which markets move. Now, at this point, I'm stepping a little bit beyond Hurst's original theory. I'm going to start speaking about things that I've observed in terms of the way in which financial markets work. And these are not things that Hurst himself actually ever wrote about, to my knowledge. And that has to do with the fact that a market will generally move from a trough of a particular cycle up to a peak of that cycle, and then down to a trough of that cycle. So in this example, the market would move from a trough of the 18-month cycle, and there is our most recent trough of the 18-month cycle in August of last year. So the market will move from a trough of the 18-month cycle into a peak of the 18-month cycle, and then it's going to move down into the next trough of the 18-month cycle. Now, where's the next trough of the 18-month cycle expected to form? Well, here you can see there's a slightly staggered nest of lows over there indicating early 2019. And so the market will move from this 18-month cycle peak that it has just formed down into the trough of the 18-month cycle, which is over there. Now, that sounds almost childishly simple, and it is simple, but there's some subtlety that I must point out to what I'm speaking about in terms of how the market is moving. I'm saying that price must move from a trough of the 18-month cycle to a peak of the 18-month cycle, then back down to a trough of the 18-month cycle. Now, I'm not looking at a single analysis on this chart. If I was looking at a single analysis on this chart, then I would be looking at a trough analysis at the foot of the chart, and the statement that I've just made wouldn't even be worth saying. Yes, obviously, when you are looking at a trough-only analysis, price will move from the trough of a particular cycle to the peak of that cycle, which is the highest price in that cycle, and back down to a trough of that cycle. That goes without saying. But that's not actually what I'm saying here. What I'm saying is that if we apply a dual analysis, which is two analyses to this chart, two completely separate analyses, we have a trough analysis at the foot of the chart. So that is an analysis, a cycle analysis, which analyzes the position of the troughs of the cycles. And we also apply a peak analysis, which is a completely separate and unrelated analysis to that trough analysis. This I've spoken about in previous webinars, and I expect that you're familiar with this concept. I call it a dual analysis. We have two completely unrelated analyses, okay? And that big word there is unrelated. These analyses are not connected to one another. The result of having a dual analysis, or two completely separate analyses, is that you get the movement that I've been speaking about from a trough in the trough analysis to a peak in the peak analysis. And now that peak in the peak analysis is not necessarily the peak or the highest price if you had only one analysis and you were trying to identify the peak in that cycle. I hope that that's clear. It's a slightly complex concept, but I'm not going to dwell on it now. We've spoken about dual analyses before. But the important thing about what I'm saying here is that we have two analyses, and that price will move from the trough of the trough analysis of a particular cycle to the peak in the peak analysis of that same cycle, and then back again. Okay, so moving swiftly on, I hope I haven't created too much confusion with that. If there are any questions, please type them in, and we'll loop back, and I'll come back and answer those questions a little later. So what's going to happen now? Well, as I have just mentioned, if price has formed an 18-month cycle peak, then I'm going to expect price to move down into the next 18-month cycle trough. Now, that next 18-month cycle trough is expected in early 2019. So the very simple answer is that we're expecting price to move down into early 2019. Okay? But that's an oversimplification, and we deserve a little more detail than that. So how will price move down into the next trough of the 18-month cycle? And this is where a concept that I call zigzags, and perhaps zigzags isn't quite the right term for it, but let me explain what a zigzag is. First of all, you get zigzag indicators on trading software, and those zigzag indicators track similar movements in the market. But what I'm speaking about here should really be called a sort of a Hurst validated zigzag, because it is a zigzag-shaped movement which is validated by your Hurst Cycles analysis. So let's take a look at a Hurst Cycles validated zigzag. A Hurst Cycles validated zigzag tells us that price will move down from the peak of a particular cycle, form a trough, and I'm going to come back to that in a moment. Then it will cross back over the center line of the move, and it will form a peak. And I will come back to that peak in a moment. And then it moves down again. Okay, so it forms a zigzag shape. Right, that is a zigzag shape. It looks a bit like a lightning bolt. And so that is how markets move, is they move in zigzag shapes from the peak of a particular cycle down to the trough of that same cycle. But now, what are these troughs here and these peaks here? I mentioned that I would come back to that. So let's come back to that and ask the question, where does price move down to? What is this trough that it forms before it gives us the bounce up? And what is this peak that it forms before it gives us the final move down? That trough, in my experience, and this is part of the concept of the Hurst Cycles validated zigzag, that trough is a trough of the greatest magnitude cycle that needs to form a trough before the final destination trough, if you like. So this final destination trough is a trough of the 18-month cycle. So therefore, this trough in the zigzag movement is going to form where? It's going to form at the greatest magnitude cycle that must form a trough before we reach the 18-month cycle trough. In that case, you can see it very clearly in this analysis. That is the 40-week cycle trough. Okay, that's the 40-week cycle trough. And now what is this peak over here? That peak is the greatest magnitude peak that needs to form before we reach this 18-month cycle trough. Okay, there's a slightly subtle difference over there. And the greatest magnitude peak at the moment, and you must remember, as price action unfolds and we update the analysis, these things might shift slightly, but at the moment, the greatest magnitude peak that needs to form is also the 40-week cycle peak, and it is, in fact, over here. So that's the 40-week cycle peak. Now, I've just mentioned that as price action unfolds and we adjust our analysis, we're going to start adjusting the position of these circles and whiskers for the arrival of the next peaks. And something that might happen, and it's something that we need to keep aware of, is that we might find the circle and whiskers for this next 18-month cycle peak sliding over to the left. It is possible if the cycle wavelengths shorten as price action unfolds. If that happens, then we might get to an interesting situation where, in fact, the greatest magnitude peak that must form before our next 18-month cycle trough, in fact, becomes the 18-month cycle peak. So then, of course, you were going to end up with two 18-month cycles, two 18-month cycle peaks within a single 18-month cycle in terms of troughs. At this point, people start saying to me, oh, this is nonsense. How can you have two 18-month cycle peaks within a single 18-month cycle in terms of the troughs? And it is possible because we have dual, unrelated analyses. Okay? I'm not going to dwell on that because you probably need to think a little bit about that. But it is possible. So let's take a look now at what we are expecting to happen. As I've mentioned with these squiggly lines that I've been drawing, I'm expecting price to move from this 18-month cycle peak down into this 18-month cycle trough, which is expected sometime in early 2019. Okay, so it's going to move down there. It's going to do that in a zigzag formation. So it's going to move down, then bounce up, and then move down again. Where it moves down to will be the trough of the 40-week cycle. Where it bounces up to will be the peak of the 40-week cycle. So that is what we're expecting to happen next. Now, let's take a look at this on Sentient Trader. Let me zoom in a little bit, and let me start displaying the zigzag tool, because we have a zigzag tool which will in fact plot these zigzags for us. So we're looking at an 18-month move. Okay, so there is the line, the center line for this 18-month cycle move. All right, this circle is where we're expecting the move to finish. So, as I've just mentioned, the simple answer is, well, we're expecting the markets to move down until early 2019. The slightly more detailed answer, of course, is that we are expecting the markets to move down to this point here. I've just drawn over that. Let me do that again. Do you see this little sort of circle there, that yellow circle? That is the time that we are expecting the zig of the zigzag to form. And there is that nest of lows, slightly staggered nest of lows for the 40-week cycle. So we are effectively expecting price to move down to that point. Then it will cross back up again. Okay, and we don't have an upper target yet because we can't possibly generate one because we haven't reached the first zig. So we can't generate that upper target yet. But once we reach this zig point, we can generate an upper target. And then price is going to come down again. Okay, so that white line gives us a little more detail in terms of what we're expecting. Let's speak quickly about some of these numbers over here, or just one of them actually. These are called the zigzag statistics for our Hurst Cycles validated zigzags. And if your eyes are a little better than mine, you might be able to see that that bottom line states valid percentage 82. What does that mean? It means that of these zigzag lines, going back through the entire analysis that we have, and I think this analysis goes back to 1995 or the late 1990s, so we have about 20 years worth of analysis. The percentage of these zigzag moves that have been valid has been 82%. 82% of the moves have been valid. What is a valid move? A valid move is very simply a move that moves in the right direction. So in other words, from a trough of the 18-month cycle up to a peak of the 18-month cycle, if price moves upwards, that's a valid move. Okay. However, if we track the move from the peak of an 18-month cycle, such as we saw here in July of, or that was August, I think, of 2016, there was a peak of the 18-month cycle, and we expected price to move down to the next trough of the 18-month cycle. The next trough of the 18-month cycle was here in August of 2017, and as you can see, price did not move down. In fact, it moved up. Can you see that? So price moved up from the peak to the trough of the 18-month cycle. Now that is an invalid move. So 82% of all of the 18-month cycle moves in this analysis, or in these analyses, these dual analyses, 82% of the moves have been valid. Okay, it's quite a useful figure because then you get a feeling from looking at that number as to, I hesitate to say the accuracy of the analysis, but you get a feeling for each cycle. If you've been tracking the analysis and you've got the analysis correct, assuming this is the correct analysis, then you have a feeling for how often you would have been correct if you'd sold at the peak and bought at the trough. Okay, so that's what the valid percentage is. So our 18-month cycle move is going to consist of a zig, then what I call the cross line, and then the zag. Okay, so let's look in a little more detail and let's consider this zig, which is the first part of the move, which we are obviously busy sort of undertaking at the moment. How do we understand the first part of that move? Well, as I've mentioned several times, that move is the move down from the 40-week cycle peak down into the 40-week cycle trough. Okay, that's what that move is. So if we display the zigzags for the 40-week cycle, then we will see how that move is expected to play out. So how is that move going to play out? Let's zoom in a little and look at it in a little more detail. So remember the rules for the zigzags. The rules are that price will move from a peak of the 40-week cycle. There's the peak of the 40-week cycle. It's the peak that has just formed in the market. Of course, it was also a peak of the 18-month cycle, but it was, sure enough, a peak of the 40-week cycle as well. And so price is going to move down from that peak into the trough of the 40-week cycle. And there is the nest of lows for that trough of the 40-week cycle. So that dashed line gives us the basic move down into that 40-week cycle. What form is that move going to take? Well, it's going to take the form of a zigzag. So price is going to first of all move down, but it's going to move down into what? It's going to move down into the greatest magnitude trough that must form before the 40-week cycle trough forms. What magnitude trough is that? Well, according to this analysis, it is in fact the 20-week cycle trough. Now, I'm going to come back to this in a moment, because if you remember in our previous webinar, we had positioned, or I had positioned, the 20-week cycle trough over here over the New Year weekend at the beginning of this year. And so we're going to take a look at another analysis that still positions that 20-week cycle trough there. We're going to consider what difference that makes, because that is something that gives us a little bit of ambiguity in terms of the analysis, in terms of what's happening at the moment. You can see what Sentient Trader has done here is, because the 20-week cycle trough is pretty much expected now, Sentient Trader has taken the bold step of actually plotting a dotted line from this low, which formed last week, and it's plotted the dotted line up to where it expects the peak to form. Where is the peak going to form? The peak is going to form at the greatest magnitude peak that we expect to form before the 40-week cycle trough forms, and so that is the 20-week cycle peak over here. There it is, the 20-week cycle peak. Okay, so the 40-week cycle move, and let me just clear that. There we go. The 40-week cycle move is expected to give us a move down, a move up, and then a move down again. Okay, so that's going to provide us with the 40-week cycle move. That's then going to provide the zig for the 18-month cycle move. And then, of course, we're going to get the move back up to the next 40-week cycle peak over here. Okay. Now we can break this down even further, and we can ask ourselves, what about the zig of this move? Well, that's that line over there. So let's take a look at that line and see what sort of form that line should have taken. So let's zoom in again, and let's plot the zigzag for the next shorter cycle, which is the 20-week cycle. Now, we have something interesting happening here, which is that the zigzag for the 20-week cycle has in fact already completed. Can you see that? It's moved from the 20-week cycle peak over there down into the expected 20-week cycle trough, which is this very sort of messy nest of lows over here, which is where we are expecting the next 20-week cycle trough. So shouldn't that have been a zigzag move? Yes, it should have been a zigzag move, and it probably was, but we don't have enough resolution to our data, because this is a daily chart, so we can't see enough detail to really detail the zig and the zag of that move. But indeed, it should have been a zigzag move. What are the rules? Well, the trough would have formed at the greatest magnitude trough that was expected to form on the way down to the 20-week cycle trough. Can you see what that is on this analysis? That is a 5-day cycle trough. Then price should have bounced up to form the greatest magnitude peak that was expected to form on the way down to the 20-week cycle trough. That greatest magnitude peak was the 5-day cycle peak. So this introduces a very interesting side effect, if you like, of tracking the progress of a market move using these zigzags. If you have a market move that is from a long cycle, such as a 20-week cycle, which is what we've got here, down to a 20-week cycle trough. Okay. And if the cycle that is giving us the intermediate trough and the intermediate peak is of a much lower magnitude, as is this case. This was a 5-day trough. So we went from a 20-week peak to a 5-day trough, to a 5-day peak, down to a 20-week trough. When you have such a big disparity between the 20-week and the 5-day, then that move happens very fast. It is, I wouldn't call it a crash, but the word crash has been mentioned. You certainly get a very fast move when you have the move from a longer cycle to a shorter cycle happening over a very short space of time. Okay, so this is, this shows us what we're expecting. So what are we expecting now? Well, as I've just mentioned, the 20-week zigzag has come down here. We're expecting a 20-week trough to form according to this analysis, at which point, of course, we're expecting the market to come up in this cross line to head up to the next 40-week cycle peak. What's it going to do as it does that? Well, it's going to continue zigzagging through the shorter and shorter cycles. So what's the next shorter cycle? It's the 80-day cycle. So we can display the zigzag for the 80-day cycle. Here is the zigzag for the 80-day cycle, and we are expecting that to come up to there, up to the next 80-day cycle peak. There's the next 80-day cycle peak. Okay, and we can display the next shorter cycle, the 40-day cycle, and so forth. Okay, so you can see all of these zigzags at the moment are all projecting this move down into a trough, which is really expected to form now. Now, before you say, wow, that's amazing, they're all going to the same place, it's no surprise, I should point out, that they're all going to the same place. They're all going to the same place for the very simple reason that our analysis has a nest of lows over here. Okay? We're expecting a low for every one of those cycles, each one of those cycles, to happen now. That's why the zigzags are pointing there. So it's not some sort of magic double confirmation. It's simply repeating the same piece of information. So we are expecting a bounce out of this 20-week cycle trough, which will then take us into the next part of the zigzag move as price continues its move down to the 18-month cycle trough, which is expected early next year. Now, I mentioned the fact that this not 80-day, the 20-week cycle trough might in fact have already formed. So here is a chart where I have, let me just zoom out a little bit on this chart. We want to see the next 18-month cycle trough. And so here we have exactly the same situation except for one detail, which is that the 20-week cycle trough I have pinned to the New Year weekend between the 29th of December and the beginning of January of this year. So I've positioned the 20-week cycle trough over there. Now, that is a possible analysis, and it might be a better analysis, but there are arguments for both. So let's just take a look, first of all, at what the difference is with this analysis in terms of these zigzags. So let's display our zigzags. First of all, let's start with only the 18-month. there is our 18-month zigzag. So that is the move that is expected down to the next 18-month cycle trough in early 2019. So far, there is absolutely no difference. The first thing that we're expecting the market to do is move down into the 40-week cycle trough. And there is that 40-week cycle trough, which you can see is expected in about May of this year. So we're expecting a move down there. Again, that is going to be a zigzag move, and we're going to zig and zag about that 40-week cycle line that moves down there. And so the first thing that is going to happen is the price is going to come down into the maximum magnitude cycle trough that is expected to form before the 40-week cycle trough. So what is the greatest magnitude cycle trough that is expected to form? Well, in the previous analysis that we were looking at, it was the 20-week cycle trough, which was due kind of round about now. In this analysis, the 20-week cycle trough is behind us. So that's not the greatest magnitude trough. The greatest magnitude trough is, in fact, the 80-day cycle. So there it is. There is the move down into the 80-day cycle, and that is expected to zigzag again. Well, that was a really bad zigzag. Let me draw that zigzag again. So we're expecting a zigzag to form around the 80-day cycle line, moving down into the 80-day cycle trough, expected sometime in March. Okay, so how is price going to do that zigzag move? Well, it's going to move down into the greatest magnitude trough expected between the peak and that 80-day cycle trough. The greatest magnitude trough is, of course, the 40-day cycle trough. So we can display the 40-day cycle zigzag. And now let's zoom in, and we can see what is expected here. So according to this analysis, this sharp move down is a move down into the 40-day cycle trough, which is expected to form now. What's going to happen next? Price is going to bounce out of this 40-day cycle trough, and it's going to complete that move of the zigzag, and then it's going to move down into the 80-day cycle trough, which is expected sometime in March. So you can see how at every level of zoom scale, if you like, at every cycle level, you get these zigzags playing out time and time again. So if the 20-week cycle trough did form back over the New Year weekend, then we're expecting a bounce now out of a 40-day cycle trough, followed by a move down into an 80-day cycle trough. Okay, and so let me just draw it here. We are expecting now a move out of a 40-day cycle trough up to a 40-day cycle peak, followed by a move down into an 80-day cycle trough sometime in March. That's what we're expecting according to that analysis. Now let's go back to the other chart and see how what we would expect from that chart might differ. Here, all the zigzags are pointing to this trough, which has not yet been confirmed, but we are, of course, expecting price to form a trough now. What's it going to do? Well, it needs to bounce up, and we have a 20-day cycle peak up ahead of us, but we have a 40-day cycle peak over there, just as we did in the other analysis. So it's going to bounce up to a 40-day cycle peak before coming down into, here's our nest of lows for the 80-day cycle. It's a bit staggered, bit messy, but it's going to come down into an 80-day cycle trough. I hope you can see how, with these two different analyses in terms of where that 20-week cycle trough is positioned, we're still expecting the same basic price movement. But what's the difference going to be? There must be a difference. Yes, there is a difference. The difference is that if this is the correct analysis, then this move up here is going to be the bounce out of a 20-week cycle trough. So it's going to be a stronger bounce. We're going to get a much bigger, better, stronger, further bounce than if the other analysis is true, in which case we're only going to get a bounce out of the 40-day cycle trough. So what do you do in terms of your trading? Well, if a 40-day cycle trough bounce is strong enough for you, then you might tentatively want to, get in for a very quick long. However, I must caution you. Look at this big peak here. When price is falling out of a really big peak like that, the bounce out of a 40-day cycle trough is not likely to be a very impressive bounce. So, we might see a bit of a bounce, but don't forget that big peak looming over everything, which is probably giving us quite a lot of bearish pressure. Because remember that most of these longer cycles, the 18-month cycle has turned down. Okay, the 40-week cycles turned down, the 20-week cycles turned down, and so forth. All those cycles are pressing downwards. So I'm not very optimistic about a bounce. However, if the analysis that we're looking at right now is correct, then this is going to be the bounce out of a 20-week cycle, which is a much stronger bounce. So if we see a good, nice, strong bounce here, then the odds will tip in favor of this analysis. As a matter of interest, let me just point out two things here. I mentioned the validity percentage of each one of these cycles, and we've already seen that the valid percentage of the 18-month cycle is 82%. The valid percentage of the 40-week cycle is 90%. The valid percentage of the 20-week cycle is 94%. The 80-day cycle, 93%. And the 40-day cycle, I can't read. So let me turn off some of these zigzags. I think if I turn off the 80-day zigzag, I can read it. There we go. The valid percentage of the 40-day cycle is 92%. So, we're getting a lot of, a very high percentage of valid moves in this analysis, which increases my confidence in the fact that the analysis is probably correct. Let's turn off those zigzags and let's just say one final thing about this position of the 20-week cycle trough. I continue to think that the New Year period was a very, very possible, very likely position for that 20-week cycle trough. However, I should point out again, let's just hide our peaks and look at just the troughs. I should point out again that in the recent up move that we have seen, this accelerating up move, the identification of troughs in this market was fairly complicated, right? Because price came down for only a day or two at a time, and so therefore identifying those troughs and the magnitude of those troughs is a fairly tricky business. So let me point out something here. If I measure from the 18-month cycle trough, and I'm fairly confident about that trough in late August of last year, I'm fairly confident that that was an 18-month cycle trough. If I measure to the position of this trough here, which is a very valid, very viable 80-day cycle trough, I get 86 days. Now the average length of an 80-day cycle is 68 days, which is over there. And our previous analysis was positioning that 80-day cycle trough in the third week of October at 65 days. Okay, but this position here in middle of November is a very valid position for the 80-day cycle. Let me point out something else. 2 times 86 is 172. And so if we move forward to 172 bars, 172 bars was exactly Friday. Now, although that doesn't mean that's definitely the correct analysis, when you see an equal number of days each side of a trough, as a cyclic analyst, your ears perk up and you take notice, because there we have 2 perfectly equal 86-day time spans, and therefore the possibility that those are both 80-day cycles, and therefore the 20-week cycle trough potentially formed last week, or certainly due now, in my opinion, is increased. So I hope this has given you a really good idea of what we can expect now, and a way in which you can track your cycle analysis or track the movement of the market as it continues to move in these zigzag movements. I'd like to spend just the last sort of 5 minutes of the content of today's webinar demonstrating the way in which the same process can be used intraday. I'm often asked about intraday cycles, and in these webinars I speak almost entirely about end-of-day cycles. The reason for that is we have one of them a month, and so I'm trying to give you some information that you can, work with over the month to come. And often intraday, is a fairly sort of limited interest, or short-term duration interest, I should say, not limited interest. But as I was considering the subject for today's webinar, on Friday, I was watching the Dow Jones pull up from the Dow Jones Industrial Average, the top 30 Dow stocks, and I noticed a perfect zigzag on an intraday level. And I thought, well, that makes a really good way to sort of wrap up the discussion for today. Here is that perfect zigzag. You don't often find absolutely perfect zigzags, but, well, you find them more often than you might expect. Here is that movement in the Dow Jones Industrial Average. This is a 5-minute chart, so each one of these bars represents 5 minutes. This is on MT4, the trading platform. I'm working with the Hurst Cycles indicators for MT4. And so where is the zigzag? Well, here is a 5-hour cycle trough. You see that white diamond? That's a 5-hour cycle trough. Okay. From a 5-hour cycle trough, we expect price to move up to a 5-hour cycle peak. There is that 5-hour cycle peak. How will price move? Okay, let's draw the dashed line for that move. How will price move from the 5-hour trough to the 5-hour peak? It will move in a zigzag. It will first move up to the peak of greatest magnitude that must be reached before the 5-hour cycle peak, which in this case is this peak of the 100-minute or sometimes 90-minute cycle. So I'm going to call it a 100-minute cycle. So price moved up to the 100-minute peak, then it crosses the center line and moves down to a trough of the greatest magnitude trough that must be formed before we reach that peak, which is again the 100-minute trough, and then it completes this move with a strong move up to the 5-hour cycle peak. So isn't that a perfect little example of a zigzag on the intraday scale? And so these zigzags are really powerful. There are several other things to say about this chart, which is why I just had to take a screenshot of it. Let's look at this line over here. How does the line move? How does the market move? Not the line. How does the market move from the 100-minute peak to the 100-minute trough? Well, it does it in a zigzag. Can you see that? That's a really skew zigzag. But I think you can see there it does it in a zigzag. And in fact, I have a more detailed chart from a different time scale. This is the 1-minute time scale. And so here you can see exactly the same movement. There's the 100-minute peak, and price moves down to the next 100-minute trough, which is over there. How does it do it? Well, it moves down to the greatest magnitude trough that it must encounter before the 100-minute trough, which in this case is this very short 25-minute cycle trough. Okay, that's a 25-minute. And then it will bounce up to a peak, the greatest magnitude peak, that needs to be encountered before the 100-minute trough, which is again a 25-minute peak. And so it then turns back down again and moves down into the trough. You can see these zigzags everywhere. I promise you, pull up a chart and start looking out for them. They're very, very powerful in terms of working out how the market action is going to unfold, given the Hurst Cycles analysis that that you're performing on your charts. Let me just go back to that previous chart that we were looking at, because you know how much I love FLDs, and these lines on the chart are FLDs, and I couldn't help just spending a few minutes talking about the FLDs on this chart. This white FLD is the 5-hour FLD. So look what happens when price crosses that FLD, which of course it does over here. It crosses that FLD and a target is generated. Can you see where that target is? There it is there. And where is that target fulfilled? At exactly the 5-hour cycle peak. That is a really accurate target, in my opinion. You know, you would it would be hard to sort of beat that, the accuracy of that target. So that's the one thing that FLDs do for you. The other thing that FLDs do is they provide you with very useful information about where price might stop moving. So let's look at what price did when it crossed this 5-hour FLD, crossed the FLD there, and it came to where? It came to this one-day FLD line. Came here, went slightly above it, and then gave us a bearish engulfing bar, which is this big red bar, coming down from that one-day FLD. So that was the end of our zig move. Then we got our center move. Okay, then price turned back up again, and it managed to get back up above the one-day FLD to achieve its 5-hour cycle target, the FLD target. Now, as a matter of interest, that target there looks like it's just floating, right? Okay, we know it's achieving an FLD target. Was there another reason maybe why price stopped there? This is why you need to keep your eye on multiple different time frames. Watch all your FLD lines. Let's take a look at this chart. This is a 30-minute chart. Do you see what happens there at the high price at the end of that move? Here is the zigzag we've been looking at. Okay, the 5-hour trough to the 5-hour peak. Can you see that line? It's a very faint line, unfortunately, because my colors aren't great. But can you see, I've drawn all over it, but at the high point of that move, what happened? Price touched the 2-day FLD. FLDs are amazingly powerful. I love them. Trade with them all the time. Here you can find price finding support at the level of the 5-day FLD. Any chart you look at, you're going to find these FLDs providing very powerful levels of support and resistance, and of course targets for price moves. Well, with that, let's see if I can answer some of the questions that have been coming in. First of all, an easy one just about the MT4 indicators. Boguslav, I'm not sure if I'm pronouncing your name correctly, says, is it still necessary to reload all time frames in MT4 to have valid analysis? You don't need to reload them, Boguslav. You have to initiate the analysis on each time frame that you want. So you start with the longest one, the monthly, and then you step down to the weekly, then the daily, then the 4-hour, the hourly, and so forth, down to as short a time frame as you want. It's a process that doesn't take very long, takes a minute or two, and then once you have initialized your analysis, then the indicators will keep going. They'll keep going for for a really long time without needing to be reinitialized. I know some MT4 users who reinitialize their analyses every week. They like to start every week with a fresh analysis. I must admit, I'm a little bit lazy. I only refresh my analyses in MT4 probably only every 2 or 3 months, to be absolutely honest. Okay, let me switch back to my desktop so that you can see. There we go. Let's turn off the zigzags here. And as David from Trading Hurst said, let's take a look at some of the FLDs. FLDs are, as you are no doubt aware. Yeah, some of my really favorite tools. So we can have a look at the FLDs and what they've been doing, and FLDs give fantastic levels, obviously, at which we expect prices to find support in the case of a falling market, or resistance in the case of a rising market. So it's really useful to make sure that you keep displaying your FLDs, so you can see what's happened. On this analysis, price dropped down through, we had a bit of what's called a cascade pattern. Don't really have time to explain that here, but we had a cascade pattern with these FLDs all sort of lining up. So when price crossed the one FLD, and let me turn this pen on again, when price crossed the, where is that pen? Okay, so obviously doesn't really want to use the pen. Let me try again. And there we go. Okay. Let's see if that will draw anything. Okay, my computer seems to have suddenly decided it doesn't really want to use the pen anymore, but I'm hoping that you can see that as price dropped down through the 20-day FLD, it generated a target to the downside. In achieving that target, it crossed the 40-day FLD, which generated another target to the downside. In crossing, there we go, the pen has appeared. In crossing the 40-day FLD, it generates another target, which meant that it crossed the 80-day FLD, and then it achieved that target, I think 1, 2, 3.5. 1, 2, 3.5. So it achieved the target for the 80-day, and it dipped down below the 20-week FLD last week, but it hasn't really crossed decisively below it yet. Okay, so FLDs are really important. Definitely something that you have to keep your eye on and watch out for. Right, other questions, and I know I'm probably going to forget some, so if you don't mind repeating them if I've missed your question. Aryan asked, would this upcoming March peak be a sensible point to exit passive long positions? So I guess what Aryan is saying is if you have like a really long-term long position, then would you wait? We've been talking in today's webinar about the fact that we're going to get a bit of a bounce up, as part of the zigzag move, and long term we're expecting price to come down again. So Aryan, the correct answer to that question is a little more complicated. Yes, you can look for a bounce and wait for price to come up again. You must remember that that as time unfolds and as the market does things, the market, I have a saying that that I get from my days working in film and television. They say in film that you need to give the audience what they're expecting, but you do it in an unexpected way. And the markets are very much like that. The markets always end up giving us what we expect, but they sometimes do it in an unexpected way. So I'm not going to. Well, I cannot give advice, first of all. Please bear in mind the disclaimers. But I would watch this bounce very carefully. Somebody else asked at some point in the webinar whether I expect new highs. Could the price come up to a completely new high? And so, in answer to Aryan's question, I would watch the bounce as it comes up. It might be because there's tremendous volatility and a lot of emotion in the market at the moment, and it might be that bounce, comes up and proves to be a lot more fantastic than we would have expected. In which case, you might want to hold on to those long positions. You might. What I'm advising is that you watch price movement carefully. Keep an eye on the FLDs. Keep an eye on the unfolding cyclic picture, and you make your decision to exit or to enter your trades when everything's making sense and when you're understanding what is happening and it seems that the timing is right. That's probably very vague, but that's the best advice that I believe I can give. Somebody asked, am I not expecting a new high? Well, no, I'm not. As I've mentioned, I believe this was an 18-month cycle peak. So I wouldn't really expect a new high until the 18-month cycle trough is formed. But of course, as we've been speaking about today, we expect a zigzag movement. And it's quite possible that that zigzag movement could do that, and we could end up with a little bit of a new high. It's not impossible. So while I don't expect a new high or yet another high in the US markets, it is possible. And Hurst Cycles as an approach to financial markets is fairly different to the Elliott wave approach, for instance, where the Elliott wave approach, once they've labeled a move down as wave 1, you get a bounce up, which is wave 2, and wave 2 cannot go above the previous peak. Elliott waves are very sort of strict in those terms. Hurst cycles aren't. Hurst cycles tell you that you're expecting the market to move down over this period of time and you're expecting the market to move up over this period of time. So, we're looking for a bounce now, no doubt about it. I'm looking for a bounce. I'm not expecting it to reach new highs, but it is possible, and it's possible that we get new highs without negating the analysis that we're looking at here. I hope that answers that question. All right, there was another question about M shapes. Right, so what I should really do is just do this on a sort of a blackboard, but I'll use this black chart as a background. So of course you know that I speak about M shapes that cycles form in markets. Again, this is not something that Hurst defined. Hurst never spoke about an M shape. It's my idea. It's my observation that cycles tend to form M shapes in the markets. And we had a question saying, how does this zigzag fit into the M shape? Because it doesn't really, right? Because the zigzag is only a 3-step move. Well, this is how the zigzag fits into the M shape. If the first peak of your M shape is the actual peak of the cycle, then your I'll draw this in a different color, then your zigzag is this part of the move, down, up, down. That's your zigzag because you're going from that peak to that peak. Okay, if the peak is in fact the second peak, let's choose a different color, then if that's the peak of the cycle, then the zigzag is this part of the move. Okay, I hope you see how those zigzags fit in there with the M shapes. All these different shapes fit together, in my opinion, and make a really fascinating. It's like this fascinating, never-ending puzzle. So, just one other thing about the M shape. The M shape, if you want to get a little more complicated, includes what's called a mid-channel pause. If you don't know what that means, then don't worry about it. But in fact, the M shape includes the mid-channel pause. And so, in fact, the zigzags that we're seeing here are a zigzag up and a zigzag down. That's the other way in which zigzags fit into the M shape. Okay, there are many different sort of combinations and ways of putting that all together. We had a question right at the beginning of the webinar. How do you know whether you should be working with a trough analysis or a peak analysis? I've mentioned several times that I'm putting more attention really on the trough analysis here. That's because stock markets tend to exhibit the characteristics of a trough analysis, and Hurst originally specified in his principle of synchronicity that troughs are synchronized. And the way in which you should decide which analysis works best, the peak or the troughs, is you should see if you can identify sharp, isolated peaks and rounded, clustered, I beg your pardon, sharp, isolated troughs and rounded, clustered peaks. I'm going to move that quite quickly because we're running out of time here. But if you can see rounded and clustered peaks and sharp isolated troughs, then that's a trough-based analysis. Now go and look at coffee, for instance, or gold. And in those markets, you will see sharp isolated peaks and then rounded clustered troughs. Okay, so that's a peak analysis, peak, whereas you get the opposite. For a trough analysis, you get sharp isolated troughs and rounded clustered peaks. Okay, I hope that answers that. And Ab says, do you expect that we are going, after the next peak, we are going hard down to the beginning of 2019? Yes, Ab. This move down is not a one move thing. We're gonna get a zigzag, and so this could be a hard move down. I tell you how you know whether a move is going to be fast and really hard, or whether it's going to be slower, and that has to do with what the distance is between the expected peak and the expected trough. Sometimes in this analysis, you will see troughs and peaks pretty much almost on top of each other. Let me see if I can find some. They're not. This is quite a well-behaved, separated analysis. But play around with your analyses, and sometimes you will see, even not really. But if you play around with your analyses, sometimes you will see the peaks and the troughs almost on top of each other. Sometimes they're literally sort of expected on the same bar. Where you get your troughs and your peaks very closely aligned like that, you need to stand by for a very sharp, strong move, because as mentioned, price is going to move from the peak down to the trough, or from the trough up to the peak, and the only way it's going to stop on the way down or up is at the shorter cycles. And if there aren't really any shorter cycles, it's going to be a strong, fast move. Okay. Bogoslav says, even if he closes and opens MT4, yes, absolutely, Bogoslav. The indicators store their analysis information. This is referring back to the analysis on the MT4 trading platform. The indicators store their analysis, and so when you close MT4, it saves the analysis, and when you open it up again, it simply updates it from where it left off. So some of my computers I'll fire them up in the morning and close them down in the afternoon. Other computers I will run from a Sunday night, close it down on a Friday night. But you only need to initialize your analysis once, and then you can start and stop really quickly. David at Trading Hurst is mentioning the M shape of the 40-week cycle. I think I might have sort of got past that. Peter Ewan says, are 80-day troughs usually the same magnitude as 40 days or lower? Peter, no. The general rule is that the greater magnitude trough, the bigger the bounce. Okay, but you have to bear in mind what all the other cycles are doing. Okay, so that's a really simple rule of thumb. But so an 80-day cycle trough should give you a bigger bounce than a 40-day cycle trough, but it doesn't necessarily. And for instance, in this analysis, which is a perfectly valid analysis, if the 20-week cycle really did form there, then you had a very small move down into it. You had a nice big bounce out of it, but it's a rule of thumb, really. It's not an absolute. It's not a perfect science. Analyzing Hurst cycles is as much an art as it is a science, which is something that Hurst said several times, and I find myself often referring back to that idea. Peter Brown, could we do an analysis of the Aussie US dollar and the Canadian US dollar? Yes, Peter, I will do. Not in today's webinar, but I will do. David at Trading Hurst says, watch for resistance of various FLDs for clues. I think that's in response to the Aryan question about where would be a good place to offload your long positions. As David says, watch for resistance at FLDs. So, watch as price approaches an FLD, watch it. See if it gives you what I call a golden cross. And a golden cross is where it just plummets beautifully and smoothly through that FLD. Or see if it finds resistance. And so if we zoom in and display our FLDs here, You'll see some examples there where, when price hit the 20-week FLD in the S&P 500, it found resistance, right? That was last week, Tuesday. It bounced up again. And that was a clear signal that 20-week cycle FLD was going to be an important one. We can isolate it there and zoom in. You can see how on Monday it just touched the 20-week FLD. Tuesday it dropped down below it, stayed above it. That 20-week FLD is an important FLD at the moment for the markets. And next question. Okay, Aryan saying thank you, and David trading Hurst. Watch what happens when price comes back to the 80-day and FLD. 80-day FLD at the 40-day peak. Yes, exactly. Okay, so we're going to be watching that FLD. Okay, and people saying thank you, fantastic. And Zeng Hui, can I use 5-minute time frames in analysis end of day, 5-day, 10-day? No. End of day, Zeng will give you daily bars. So the shortest cycle you can work with an end of day. I presume you're talking about an end of day copy of software. The shortest cycle you can look at is the 5-day cycle. That's what we're doing here. You can see these 5-day cycles on the chart. That's the shortest cycle that you can find in the analysis. But using daily data and identifying 5-day cycles is a really rough process because you've got very little detail. So the shortest cycle that you could really get enough information about to trade with any confidence must be at least the 20-day cycle. So on a 5-minute time frame, you could be trading a cycle of about an hour and longer, perhaps perhaps the half-hour cycle and longer on a 5-minute bar. On daily data or daily bars, the shortest cycle you could really trade would be about the 20-day cycle. I hope that answers that question. And on that note, if there are any other questions, I will be very happy to answer them. But I think it is now time for me to wrap up the webinar and to say thank you very much to all of you for joining me. And there we go, there's our slide. Thank you for joining me. I hope that this has given you some idea of what to expect now that we have seen our peak. Thank you for your interest in Hurst Cycles. I wish you a very profitable month ahead, and I look forward to seeing you at our next webinar, which will be in March. I look forward to seeing you then.